So hopefully you get something out of it. And I kind of tricked you a little bit. This is more like a boot camp for first year financial advisors. So we're gonna cover some concepts real quick, just so everybody's on the same page, and then we're gonna dive into it, and it's gonna get pretty heavy pretty quick. So I hope you guys are ready. Like everybody says, you get out what you put into it, and I hope you guys can interact, ask some questions. I'm not going to be able to see the chat, so if you guys can admit people or come off mute to ask questions, that would be great. Let's see. All right, let's get started. All right, these are my credentials. I'm going to take these down real quick. Always check the credentials of your financial advisor. Like I said, all they have to do is pass a test to become a financial advisor. Um, and you never know how much experience they have, what kind of licenses they have. But at the end of these three courses, you will probably know the same, if not more, than a first year advisor, a second year advisor, a third year advisor with no experience. So that's what this class is about. I have to put this stuff in there. This Army stuff, you guys know that. Um, all right, here's some things we're going to cover today. Risk tolerance. These are pretty basic when you meet your financial advisor for the first time, or you're trying to be your own financial advisor. Got to analyze risk to reward trade off, determine asset classes, benchmark investments. That's a huge one, and then dollar cost averaging, and I'll show you the power of dollar cost averaging. It's like a mathematical miracle. Okay, but first off, we have to get on the same page on what savings is so we can move on to investments. Okay, savings is simply positive cash flow. Okay, that's it. At the end of the month, do you have anything left over? That is the building block of any investment. That's what you have to know. That's like exercising. Okay, you're not going to get buff if you don't exercise every day. You're going to have no investments if you don't have any savings. Okay, all it is positive cash flow. Now, you could say a savings account may be an investment, and we're going to get to what constitutes an investment or not. But savings is simply positive cash flow, and you have to have it to have any sort of investment. Okay, so positive cash flow, then you're able to invest. Okay, now an investment takes one, you need a goal, you need education about it, and you need a time frame. You can't have a you can't have an investment without a time frame. Okay, because then you're not doing anything. It's not saying you don't want just the biggest return that you can. That's not how investing works. Okay, you have to have a time frame in order to make it work. You have to have a risk tolerance in order to make it work. How much are you willing to risk versus how much reward you're gonna get? Do you have to get to that goal, or is it a little more flexible? And we're gonna get into how you make goals in a second. But if you don't know if you're positive cash flow or not, then are your investment life is too complicated. Okay, you have too many accounts. Okay, this is what it should look like. Okay, beginning balance, you got all your deposits and credits up here. You have your withdrawals down here, and then you have your ending balance. This person has positive cash flow. They went from 13,000 after everything was paid, then now they're at 51,000. This is the start of this person can now start investing. Okay, you need to be able to know if you have positive cash flow, how much it is, how consistent it is, and before you can even start investing. Okay, so that's step one. Even if you don't know it right off the bat, right this second, you should be able to get it within maybe logging on to one or two accounts. Know if you have positive cash flow. Okay, and a lot of us, I have a psychology class, the psychology of money, and we look into like what it takes in order to stay disciplined, have courage. A lot of us don't like to look at our accounts because we kind of messed up over the weekend, but if you're interested, there's that as well. So we're all on the same page with that, hopefully. Let's look at risk tolerance. Now, if you go into a financial advisor's office, the first thing they're going to do is pull out a questionnaire. Hopefully you guys got that one from Edward Jones. I like that because it explains a lot, and it has the portfolios at the end, and we're going to look into that in a second. But a lot of them are just real basic. Like you put down a number, and then they tally up all the numbers, and they tell you what your risk profile is. Okay, and we're going to do that today as well. So, evaluating risk. There's a risk to reward trade-off. Okay, this is properly evaluating the risk and weighing this against the potential award. It's just like we do the gambling all the time. We do shopping all the time. It's no different than that. Okay, many of us dream of owning a business. That is probably the biggest risk to reward that you can possibly take. The majority of businesses fail, and if you want a restaurant, the vast majority of those businesses fail, and we all like to share our food. Okay, so that's it. One on the businesses on the high end, very risky, but you have to weigh that against the reward. On top of that, we hesitate to invest in stocks. Why do we hesitate to invest in stocks, but we won't hesitate to get our own business? That risk to reward, there's something off there. Okay, like Amazon. If you were to go to Amazon and buy their stock, then they have warehouses, they have operations, they have loyal customers, they have positive cash flow, they have everything that a healthy business needs to grow. The risk to reward on Amazon is extremely good. Okay, I'm not endorsing that stock. We'll look at how to evaluate stocks a little later, but right now we're looking at risk to reward and kind of conceptualizing what that means and put it in the proper perspective. Okay, so the first component of risk to reward trade-off is the risk tolerance. This is the willingness and ability to endure fluctuations in the value of investments. You see it go up, you see it go down, you see it go up. How nervous does that make you? How far down does it have to go before you say, I'm done? Do you have the unrealistic view that it may go to zero? Okay? Those are all, irrational. And we have to gauge those. Because if you're not sleeping at night, then your investment is probably wrong for you. Okay? Now, losing money is not the only type of risk. There are tons of risk. Every single investment there has a risk, and if they say it's risk-free, then that just means that they don't know the risk or they don't see the risk. So, for instance, liquidity risk is in real estate. What does liquidity risk mean? Liquidity risk is the idea that you won't be able to get out of it. Okay? You won't be able to get your money out. If you live in the house and you have money in the house, equity in the home, you would have to sell your house to get that money back out. If you have real estate or if you have property that is rental property, you have to get the tenants out, you have to fix it up, and you have to be able to sell it for a profit over what you owe. That's a liquidity risk. Not easy to get out of the investment. Okay? My brother was upside down in his California houses for about 22 years because the base closed down. Okay? Liquidity risk, huge. Stocks have market risk. These are going to fluctuate up and down. Okay? We all know the risk of the stock market. Okay? But there are ways to mitigate that risk that we're going to cover today. All right? Horizon risk. Horizon risk is you put together a beautiful plan. In 50 years, you'll be able to retire with $3 million or whatever. Your positive cash flow, everything's going in the right direction. and something like catastrophic happens. You lose your job, you have medical expenses, something like that. That is horizon risk. Okay, that is the chance that your plan that you laid out won't come to fruition because something major happens. Now you could stack these risks on top of each other. Okay, so let's say you have horizon risk. Let's say you lost your job, and your primary investment is real estate. Now you have to go through all of those steps to try and get at your money, which is in real estate. So you have horizon risk and liquidity risk. If all your money is in stocks, you're at the mercy of the stock market. If it's down and you lost your job and you have to sell, you're going to sell at a reduced rate. Okay, if it's up, you may have lucked out. So we could spend days and days and days on the types of risk. There's inflation risk, there's sector risk, lots of risks out there, and what we're trying to do is mitigate all of the risks and determine risk to reward trade-off. Okay. Oh, one more I want to cover. Savings accounts are longevity risks. This is that you outlive your money. It's not growing quick enough, and you won't be able to reach your goal. Your money's not going to last. You keep dumping all your money into a savings account, you have to do it at a rate that will not only keep up with inflation, but keep up with your earnings. So savings accounts have huge longevity risk. Okay. All right. Let's take a look at our risk tolerance questionnaire. Okay. This is the first thing a financial advisor is going to talk to you about. I do not endorse Edward Jones. Never been with Edward Jones. Don't know anybody in Edward Jones. Like I said, it's just I like their this form. They explain everything very well. They have elaborate, questions here. So it goes from A, B, C, D. This is the question. This is the answer, and it goes from least aggressive to most aggressive. Okay. So if you put A here, that's going to be the least aggressive answer here. Your goal is to minimize swings in my portfolio, even if the growth does not keep up with the pace of inflation. Okay, that is going to be like a retiree's account, somebody who lives off their income. Okay, so hopefully you guys had a chance to look at this. We're going to go through this a little quick. C here is the biggest one. A is the least. I want to get down to the bottom here. You guys can fill this out on your own if you would like. You need to know what your risk tolerance is before you can even invest a penny. Okay, and this risk tolerance changes over time. In your 20s, you're going to have a different answer than when you're in your 40s, and you're going to have a different answer when you're in the 60s. So as a financial advisor, you have to get this maybe every 5 years. Do a new one of these, stick it in their file, reevaluate their investments. Okay. Here are the fluctuations. A to C. C is the most aggressive. A is the least aggressive. You only want this to fluctuate between 115 and 90. Now these are just hypotheticals. There's no investment that can guarantee these. This will go between 125 and 80, 135 and 70. So let's say you invested 100,000. Would you be okay with it going down to 70? Everybody's going to say no, I'm not okay with that. But would you sell is basically what they're saying. Okay. Now, would you trade that risk at the chance of getting 135? That's what this is asking you. Okay. Let's go down to the bottom here after you've all filled it out. This is just the same, different question, but it's looking at the same thing, the fluctuations. Okay. Now, scoring here, if you answered A for all of them, then you're super conservative. You could do a mix. You add them together. If you have a risk tolerance that's super high, your score is going to be between 80 and 100. Medium to high, 60, 79, and so forth. If you have 0 to 18, you're going to be extremely low risk tolerance. You have no patience for fluctuations at all. You need your money. You need to know exactly how much you have and exactly how much it's going to grow. These, so this corresponds to this, corresponds to the type of investment. This is what's called the retirement time horizon. How long do you have to retire? And you combine that with your risk tolerance in order to get at the appropriate investment. So if you look here, it goes from most aggressive, growth focused, all the way to income focused. Now, if you have TSP, okay, this is what your life cycle funds are doing for you. Okay, if you're in L70, you're going to be over here, or L2070, you're going to be over here. And as you age, as you get closer to 2070, your investment or your portfolio is going to move automatically. TSP does this for you, move automatically down here to income focus. So at some point, when we reach 2065, it's going to turn into income focused because it went through this risk tolerance profile and you invested in L2070 based off of how many years you have left. If you have 26 or more, you can go with the fluctuations, and I'm going to show you why fluctuations are good here in a few minutes. But that is the reward risk to reward trade-off. That if you guys have any questions on this form, you can come off mute if you want. But here basically is what the summation is. Okay, risk tolerance, ability to take risk. Those components are liquidity, how much liquidity you have, how much in assets do you have, and do you have a lot of time? That's your ability to take risk. Your willingness to take risk is a little more subjective. This is your investment experience. Oh, Amazon's down now, but they have, these assets and they'll be able to rebound. Or WBA, which is Walgreens, they're so much in debt, they're gonna go out of business. I need to get out of that. I'm not willing to take risk on that. That's the investment experience portion. Okay, your attitude towards risk. That's part of what the questionnaire was about. Could you sleep at night if your $100,000 went to $70 or $70,000? That would be your attitude towards risk. And then your investment knowledge, how much you study your portfolios. And we're going to get into those, how to do that as well. How are we doing on time? Alright, doing good on time. Alright, the next portion of risk to reward trade-off is the probability that the return will be realized on a consistent basis. Okay? You have to be realistic with the investment you're pursuing. Like the business owner. Okay? You may be good at fixing trucks, but you may not be good at getting clients or getting trucks into the shop. You have to be realistic with your investments. Okay? The reason why real estate and stocks are the most heavily invested in is because they are tried and true methods and have abundance of information available to them. There's not a lot. You can't just go in and Google how to open a restaurant. I mean, you can. It's going to be really subjective. It's going to be pretty sketchy information. But if you go in and you analyze a stock, there's going to be 50 analysts on one stock telling you what their opinion is, what their growth factors are, what their ratios are. Tons of information on them. Okay. Same with real estate. Every guru out there has all these tried and true methods of investing in real estate. Pretty easy to, well, it's not easy, but it's been done before, which that's what you want in investments. Okay. All right. Where are we? Okay. These vehicles are tried and true. They know how to work. The type of account is also important to align with your goals. Okay. You have to be realistic. If you're putting money into a savings account, what's the chances that that's going to get you to your goal? Okay. If you're investing in IRA accounts and your goal is to buy a house, that's not realistic either. You're not going to be able to get the money out of there. sufficiently, it's not a very efficient way of reaching your goals. Okay, so let's take a look here. The risk to reward trade off, real estate. Now, I went through this a couple years ago. I had a chance to either invest in real estate or put a lot into stocks, and I chose stocks because one, I was worried about consistent tenants. Okay, I didn't know where to find tenants. I didn't have any army buddies that needed a place, so that was also an issue. Right now, if I were to go get a loan on a home, it'd be about 20 some percent on a rental property. Could I get enough rent for that? Could I get enough rent to cover the mortgage? That's another issue. Am I realistic about what I'm trying to accomplish? Okay, do I have money for repairs? Just because I could afford the home, just because I could find consistent tenants, if the furnace went tomorrow, would I be able to cover that? Would I have the expertise to do it myself? Okay, those are all risk to reward trade-offs in real estate. I met a guy at the Yellow Ribbon, handyman. He can build anything. He loves real estate. He rents to his buddy. That he's in a different situation for investing in real estate than I am. Completely different situation. Okay, his risk to reward calculation is very different than mine. Okay, stocks. Are you properly diversified? Do you have everything in Tesla? Okay, do you have cash to take care of if there's market dips? Okay, do you have a coherent strategy, or are you just in on Reddit following some guy and telling you to buy or sell? Okay, are these realistic? Is Palantir going to go to 500? I mean, that's like 600 times their earnings potential at the moment. That's insane. That's not realistic. Okay, are the markets going to go to zero? No. Are they going to go to? Are they going to gain 100% in a year? No, they're not going to do that either. Okay. Is your Bitcoin strategy going to pay off? Don't know yet. Is it realistic? Probably not. Okay? So, you have to be able to look at the risk to reward trade off and take the appropriate steps, put together a coherent strategy on which investment you're going to use. We're going to primarily focus on stocks, but we're just getting this risk to reward stuff out of the way. Super important. Okay? Businesses. My dad was a business owner his entire life. My mother-in-law owns a CPA firm. Operations. Are you realistic with the operations? Okay, do you know how to run a business? Has this kind of business been ran before? Has it been ran the way you've run it before? Have you seen it ran before? Okay, what's the opportunity? Are you in a market that's saturated? Okay, do you have the proper building for whatever it is? Do you have the proper equipment? Can you get the equipment? Do they have vendors? Can the vendors deliver to you? Okay. Another biggest thing with businesses is exit strategy. Nobody knows how to get out of these businesses. Okay, you have this trucking company. You could sell the trucks. Okay, hard to sell your clients in a trucking company. Hard to sell your clients in a CPA firm. Okay. So that's the risk to reward trade-off. You have to take these into account before you jump in and invest in these. So, like I said before, savings IRA accounts, are these aligned with your goals? You could just be dumping money in a savings account with no goal, and that's like saying, I got buff doing nothing. I accidentally got in shape. Not going to work. Okay? IRA accounts are for long periods of time. If your goal doesn't have a long period of time, then that's not the right account for you. Okay? These are two opposite ends of the spectrum in terms of your time horizon. Savings account is super short time horizon. IRA, super long time horizon. Okay? I know I'm going through this kind of fast. I am recording it. It's going to be on YouTube, and it's going to be posted to our website. Family programs. So hopefully you can go back and take a look at that. Okay. Now, your time horizon. This is how much time you have to reach your goal, whatever that goal is. We're going to put together, we're going to look at how to um, formulate goals, how to consistently get to your goals. Okay? Investment time horizon is absolutely necessary. You need to know how much time you have to get to your goal. Okay? Now, this is a compound interest formula. Everybody knows about compound interest. You just put it in your handy dandy calculator online and you can see it extrapolate, and you're going to take your $10,000 and it's going to turn into $100,000. Everybody has that calculator, right? But do you know the compound interest formula? That is what is going to determine what is important in your investment. Okay? So if you look here, it's to the power of time. To the power of time. That is the biggest component in compound interest. Okay? The next biggest component is how many times it compounds. Right? How quickly is that wheel spinning? If it's spinning slow and it only compounds once a year, is it going a little faster and it's compounding quarterly? That is the second. The third is the interest rate that you're getting. Interest rate over how many times it's compounding. Okay, so that's the order. You want time, interest rate, how many times it's compounding. Okay, notice I didn't say anything about money yet. Okay, maybe you're not saving enough. Maybe you don't have it. Maybe you don't have the big lump sum. Okay, that's not a big deal. As long as you have time and you're getting a decent interest rate, you should be fine. Principal is the least. What you start off with is the least powerful in the compound interest formula. I didn't pull out the one that has the payments, but it's payments is powerful. How much you're putting in on a consistent basis, interest rate, number of times it's compounding, amount of time you have. That's the compound interest formula, and that will give you a sneak peek into what are the important things in reaching your goal. Okay. All right. Let's talk about asset allocation. Okay. Asset allocation is the mix of your investment. This is most commonly limited to stocks and bond portfolios, but it can also include savings accounts, real estate holdings, even investments like jewelry, cars, and art. Okay, we're going to focus on stocks because that's the least labor intensive, limited upkeep, most widely accessible. Okay, my wife inherited a large jewelry collection. She said, I have a lot in stocks. Well, compared to your jewelry collection, you don't. Your asset allocation is 95% jewelry. That may be a problem. Okay, so you have to factor in all your assets into your asset allocation and see if you are appropriately allocated. So, if you guys have heard the term house rich, that means your house is where all your money is at. You are a real estate investor if all your money is in your house. Okay, that could be a problem as well. Um, so you don't want to limit your asset allocation just to that one account or just to your TSP and ignore the other accounts. You want to consolidate everything and look at everything that is worth any money to you. Could be a gun collection. It could be any kind of asset. You want to take a look at it, add it to your asset allocation, and see where you're overweight or underweight in terms of your assets. Okay, like TSP. I have a lot of people that say, I have, $100,000 in my TSP. It's aggressively invested. I said, okay, how much do you have in your savings account? Also $100,000. Well, that's not an aggressive asset allocation, is it? Because only half of it is invested aggressively. The other half is not invested at all. So you have a 50-50 split and you are not aggressive. Okay. Now, if you go into your risk tolerance questionnaire and you see that that's a proper allocation, that may be fine. But you can't tell me that you're aggressive when only half your assets are in the aggressive portion of TSP. Okay. I have some examples here. Okay. Asset allocation is, like I said, related to your time horizon and your risk tolerance. How much are you willing to risk? These are very typical asset allocations for stock portfolios. Okay, you have your average return here. You have your best 12-month return, and we're gonna get into tools on and how you properly analyze your portfolio. I'm just trying to lay the foundation so you know what you're looking at. Okay, 5.8. This one's all 9.4. This may not seem like very much to you. Oh, I'm taking X amount more risk just for a little over 0.5%. Well, again, we're talking about compounding. That's an average annual return. How fast is that compounding? How many years do you have? You're talking about 0.5% on what kind of money? You put this in a growth compound calculator. This 0.5%, based on what your goal is, could make or break your investment goal. Okay, the best 12-month return. This is probably how good it's ever gonna do ever. Okay, this one did 136% at one point. This one only did 31%. So think of this as the potential. How much potential does this investment asset allocation have? This one's only went down by 17%. That's the worst 12 months. So on a 12-month period, any 12-month period, it could be from October 9th to October 9th the following year. The worst period of time for this portfolio. So the high 31, the low 17. High 76, low 40. Negative 40. High almost 110, negative 52. High 136, negative 10. So this high is, what is that? A little less than 20. And this, a little over 20. And the low is less than 8% difference. So that is a proper risk to reward trade-off. Okay, you're sacrificing a little bit of the growth for a little bit safer investment. That's what this is telling you. Okay, the best 20 years that this portfolio has ever done is 11. This is a 20-year run. Okay, this is annually. So 11, 11, 11, 11, 11. It didn't do 11 every year. That's just the average over that 20 years. Okay, this one did 16 and a half averaged over the last 20 years. The worst 20 years, they're all about the same. So if you're saying that stocks are too aggressive, stocks are not for me, I like real estate, I'm an entrepreneur. Again, go back to your risk tolerance, go back to what you're good at, go back to how consistent those returns are. It doesn't get much consistent than this. It doesn't get much more consistent than this. Even in real estate, it doesn't get as consistent as this. I had my brother had 6 years where he couldn't find a tenant, consistent tenant. So he was calculating that his return on investment would be 11% a year. It was more like 3% of the year because nobody was paying rent for long stretches of time. Okay, now we can evaluate how long the bear markets are. Bear market is how declining market, and how long the bull markets are. That's a increasing market. The bear markets typically are extremely short, whereas the bull markets are extremely long. And that is why these 12 worst returns are pale in comparison to the 12 best returns. 12-month rolling best returns. Okay. All right. I am about 40 minutes in. All right. I hate that I'm not maximizing my money. All right. I covered a lot right now. Just wanted to take a temperature of the room. Anybody have any questions? Anybody confused on anything so far? We're gonna start. We're gonna progress a little more aggressively as well. Is this too much? Joe, you have a question? If you have a question, I can't hear you. All right. How much of your gross would you encourage us to invest? How much of your gross would you encourage us to invest? Gross income. Okay. So I think I'll be getting to this a little later, but I don't know. I can explain now. So, one, do do not compartmentalize your money. I know sometimes we like to do that. We like to say, okay, this is my money over here for entertainment. This is my money here for you know whatever. We like to compartmentalize our money. Um, and that is really tricky to get into. Think of compartmentalizing your money like cheat meals. Okay? If you have too many cheat meals, you're not reaching your goal, okay, of being fit. Okay? So what I do is now this isn't I'm not telling everybody to do this because I know what I'm doing. Um, but I have my brokerage account, which is a all my stocks are in. I have cash in the brokerage account for investments. Tanking. When the market tanks, I could invest more. I have a debit card to that account, and that's the only debit card I use. So I'm not compartmentalizing my money. Every dime I spend is money that I cannot invest. Okay, so the moral of the story is invest until it hurts. Because what you're doing is you're sacrificing now for your future self. And I don't think that's the psychology of money. We have this idea that we have this scarcity mentality where we think our income's going to go away, or we think the market's going to crash, or we think, you know, some kind of catastrophe, and we have to, my health is going to be failing, so I have to travel. Whatever scarcity mentality you have is probably not rational. So make it, like I said, make it hurt. You should be saving enough where you can feel it, because you feel your car payment, you feel your mortgage, you feel that electric bill. You should be sacrificing enough for your future self that your future self will like you in the future. Okay? Just like Staff Sergeant Hunt, I hate that I'm not maximizing my money. Well, it's not you today, right? It's the 18-year-old you, or the 20-year-old you, or the 25-year-old you. That's the guy you don't like. I'm 44. I want to like myself at 44. I want to say that guy at 44 was the best. He hooked me up. Okay, so that's kind of, I don't know if that I don't know if that's an answer for you, uh, Sergeant Hunt, but that's what I say. It's up to you, but like I said, you're trying to reach a goal. Just like you have to diet to reach that fitness goal, you have to work out for that fitness goal. That's painful. That takes dedication. That's the same idea with your income. Okay. I hopefully that answers your question. Any other questions? You guys want to continue? Is anybody listening? All right. It's gonna be on, like I said, on YouTube. Is slide deck available? I could send it out to you. I could send it out to you, but here's the thing. We're going to get hands-on in the next class. And I'm going to set you guys up for that as well. I'm going to show you how to do your own research. I'm going to show you how to construct your own portfolios. Okay? And there's tools to do that. And so hopefully you don't need the slide deck, and I'll show you how to use the tools, and that would be in lieu of the slide deck. But I can definitely send that out if that's something you guys want. All right, let's move on here. All right, that's asset allocation. Let's talk about diversification. We all know about diversification, right? This is spreading your investments around inside of an asset. Okay? That's diversification. So if you have real estate, don't have all your houses next to each other. That's the same market. If that market crashes, that's all your eggs in the basket. Okay? That's why people have rental properties all over the place. People, why don't you buy 6 in the same neighborhood? Well, that's not diversification. Okay? If that market crashes, or if there's bad water, or anything could happen that could crash everything. Okay? For us, we're talking about asset allocation in terms of stocks. Now take a look at this. I know this is busy, but if you can focus for a second, this is very popular in the financial advising world. A lot of advisors have this on laminated. And what they do is they say, okay, let's look at cash. Cash is down here. Let me show you how to read this. These are the best performing asset classes up here. Okay? Second, third, all the way down to the least performing asset class there is in this year. Okay, so, and the keys down here. Okay, cash, high yield bonds. So let's go through this for a second. Follow the cash. If you printed this out, you could draw a line. Follow the cash, 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 cash up here, 0. Notice it was 4th best, and it yielded 0. Okay? Let's go down here, worst. Right here, best in 2018, 1.8%. Okay? Back, it yielded more the following year, 2.2. But it was the least performing asset class. Okay? Goes up here again, 2022, 1.6, and so on. 2023, when interest rates went through the roof, everybody was happy they're getting 5%. Least performing asset class. So look at cash. Every time cash is outperforming, it is the least performing asset class. When it's doing okay, that means everything else is crumbling. Okay, let's look at the one that's typically the highest, REITs. These are real estate investment trusts. These are funds like mutual funds, ETFs, that invest only in real estate. So, for instance, you could have a real estate investment trust that has 9 casinos in it. And it gives you the return of how those 9 casinos are operating. They're operating well, then you get a nice return. If they're operating poorly, then you don't get a very good return. But what's consistent in these real estate investment trusts are the managers. I mean, look at, let's say it's a casino. Let's see, it's MGM Grand. How long has MGM Grand been around raking in money? Forever, right? MGM Grand has been there forever. I remember when the pyramid was being built, and it's still there. I was 4 or something. I don't remember. But anyways, that's consistency. And look at how it's been performing. 28%, 28%, 8%, 19, best performing asset class. 2015, best performing asset class. This was a pretty crazy bull run right here. We had from 2016 to COVID. And then boom, following year, 41%. Okay? If you follow that, it stays pretty high consistently. Now again, what this is used to what this is used for is to show you diversification. Now, what a financial advisor would be showing you, or what you should be showing yourself, is okay, don't just invest in REITs, don't just invest in cash. If your portfolio is diversified, you'll be this AA. This is an asset allocation portfolio. This is like what I showed you in the previous slide. Okay? Whether this is conservative, it doesn't tell you whether it's conservative, it doesn't tell you whether it's aggressive or not. But if you follow this, it's taking the best of both worlds, taking best of all the worlds. See how it's right in the middle? You're not the least performing, but you're not the best performing. Now you say, I want to be the best performing. Well, do you want your portfolio to go from -5 to 41 back down to 25? That would give me a heart attack. That would that would give most of us a heart attack. And what if you had a catastrophe in this between 21 and 22? You had a catastrophe, you had to withdraw. Okay? This is why you determine your asset allocation. This is why you diversify. You're getting this consistent return, and if you leverage that against time, that's going to compound, and that's going to give you the best results over the longest period of time. Because if you look here, large caps average 13. So see how they average, even though REITs look like they're the best asset class, if you average everything out in terms of their performance, they only return 10%, whereas large caps did 13. And large caps were only the top performing asset class in 2019. That's it. This is your Amazons, this is your Apples, this is your Nvidias, this is your huge companies. Okay? They're almost never the top performing class, but over time, they're going to give you the best. Now, this is why people say invest in the S&P 500, because the S&P 500 is all large caps. So if you were in the S&P 500, you'd be this orange line right here. Okay. So their worst is 18. Let's see, small caps. This is your Russell 2000. International stocks. Let's see, emerging markets. This is tiny countries or third world countries. There's REITs. There's high grade bonds. And then high yield bonds. So these are your good bonds. These are your kind of not so good bonds. And then here's your cash. Here's your asset allocation. Annually, it returned 7.5% every year. Best was 24, worst was 16. So like I said, it keeps you right there in the middle. It's 2% better than the S&P in terms of losses, and it's 6% worse than large caps. Now again, this is the past. What we don't know is what's going to happen in the future, and that's again why you diversify. That's why you're in that asset allocation. So when cash is the best performing asset, you get a little bit of that. When emerging markets is the worst performing asset, you only have a little bit of that. Keeps you right in the middle. Okay. Let's see. Let's look at market indices and benchmarking. Okay. A market index is just a statistical measure that tracks the performance of a specific group of investments, such as stocks, bonds. This represents the segment of the financial market and tracks the prices of the basket. So, if you're in the S&P, if you're tracking the S&P 500, that's the 500 stock prices of the largest companies that we have, and it just tracks that. Okay, so it averages Apple, it averages Amazon, it averages all of those. That is basically the economy of the U.S. in some terms. Okay, and that's why it's the most popular investment. Let's take a look. This is the S&P 500. versus what's called CPI. This is Consumer Price Index. This is inflation. Okay. CPI tracks a basket of goods. So the same goods, meats, dairy. It tracks that and the prices of that. So like I said, all it is it's just tracking prices. Okay. There are some investments where you could go in and you can also invest, and your investment will track the prices. But if you're in an ETF that tracks the S&P 500, you don't own all of the stocks in the S&P 500. Your investment is just tracking the price of that. Okay, there are, and I'll get into this next class, but there are investments that track large companies, large caps. You can't invest in all 500. That's too many positions. Okay, to own. So no mutual fund is going to own all 500 stocks. It's just not going to happen. So, like I said, this is what you compare your investments to. So your large cap, let's say you're in a large cap mutual fund, you're in a large cap allocation, let's say you bought large companies on your own. This is the index you would compare it to. So if your investment did not look like this, let's say it was substantially lower than this, your investment's not doing very good in terms of, because you're tracking against the index. Okay, so the indexing is how you track if your particular investment is good compared to what the stock market is doing or what the whole market segment is doing as a whole. So that may not make sense, but maybe this one will make a little more sense. So this is inflation again. That's the bottom line. Barclays U.S. Aggregate. This is bonds. So this light blue line is bonds. That's what bonds did. So if you have a bond portfolio, and this is why you have the tools. I'm going to show you how to do the tools next time. But this is why you have a bond. If you have a bond portfolio, you can overlay this bond, the Barclays U.S. Aggregate, and see how your bonds do. Were they underperforming? Were they overperforming? Are they too risky against what the Barclays Aggregate is? So this is how you measure your risk to reward. Okay, so if your investment is underperforming, then you're probably taking on too much risk for what the potential reward is. Okay, this is your international investments. That's the pink, or no, that's the purple. Russell 2000 is the green. S&P 500 is the red. And then the real estate investment trust is the blue. So whatever your investment is, there's a index that you could track it against and make sure that your investment is performing optimally. Okay, and it's pretty easy if you have the right tools. And like I said, we're gonna get to the tools. All right. Let's see. I'm gonna switch gears here in a second to goals. Anybody have any questions now? Like I said, I'm gonna switch gears a little bit. Alright. Where is my presentation? There it is. Alright. Let's go. Alright. Let's look at how you make goals. Okay? How you know what to invest in for your particular goals. Now, in the retirement industry, we talk about a defined benefit plan and a defined contribution plan. One is a pension, one is like a 401k type thing. TSP is a defined contribution. But we're going to use those terms for goal making. Okay? So, if your goal has characteristics on the left, You have to know how much money, what your end number is going to be. Okay? You need a defined ending amount. So if you say, I need $20,000 to buy a home, okay, sample goal right there, home. I need $20,000 to buy a home. I 100% need 20,000. I can't have 18. I can't have 15. I need 20. Okay? So, you need a defined ending amount, a defined time frame. I need 20,000 in 5 years. Okay? That means you're going to need more of a predictable return. You can't be taking a bunch of, well, you can take some risk. It just has to be a predictable return. So over 5 years, maybe you could get in a bull market, or maybe it'll be one bear market in there, but it's going to be pretty consistent if you're in bonds or treasuries or like dividend stocks. And we'll get into the different types, how these perform, but this is how you set the proper goals. If you need to pay for college in 15 years and you need $100,000, okay, again, you need more of a predictable return. It doesn't have to be as predictable because you have more time. So the time frame is going to matter. So again, we're going back to being realistic about your goal, being realistic about the returns. Okay, and that's again, I'm gonna show you the tools the next class, how to use them, how to get them. But again, that's a defined benefit plan. You need to know how much you're gonna have at the end, and you need a time frame. That kind of goal is gonna be like college or home, or something other than something that fits into those parameters. Now, defined payments. This is where you're going to define how much you're contributing every month. This is going to be probably the most, businesses use the one on the left. You could use the one on the left as well. The one on the right is probably what we're a little more familiar with. We don't know maybe when we're going to retire. We don't know when we're going to start withdrawing money, right? We don't know if we're going to get sick in the future. So all you're doing is you're putting away money. Defined payments, $200 a month, $500 a month, whatever it is. You have a variable time frame. Okay? It could be 5 years from now, or it could be 20 years from now. This would be something like a vacation. We all know about the retirement one. Let's say you are planning a European vacation. You don't know where, you don't know if it's Germany, you don't know if it's Spain, you don't know if it's Italy. You're just planning a dream vacation. Okay, you know maybe how much it's gonna cost. You know you need between 20 and 30,000 maybe. It's gonna dictate how much you save. Is gonna dictate what kind of hotels you're in, what kind of food you're getting, how much if you're going first class or not, how many museums you're gonna see. That's all variable. You don't need to know that right now. All you need to know is you're going on a vacation sometime. Okay? Just like retirement, you're going to need money sometime. In the future, way down in the end. Okay? Sample portfolio for that would be like the S&P 500. It'd be like growth stocks. It'd be like high yield bonds. What you don't want to do is you don't want to mix and match these. Okay? When you're making goals, you want to kind of keep these in their little buckets. Otherwise, it's going to risk you meeting that goal. Okay? If you're in treasuries, down here, very predictable return, you may have to skimp on your vacation, or you may have to put in way more money than you wanted to. Okay? Because it's not having aggressive returns. All right. Now, if let's say you're in the S&P 500 and you're saving for college, and you need 100,000, and then all of a sudden COVID hits and you're down 20%, and you just have 80,000. Not going to be able to cover all 4 years of college. Okay, so you have to know what your goal is. what your time frame is, what your risk tolerance is, and then you're able to put those into the proper buckets and have a better chance of reaching your goal. Like I said, you don't get buff on accident, right? So, and again, inside of these, you can uh, you can have different risk levels. Like high yield bonds are going to be less risky than the S&P 500. Dividend stocks are going to be more aggressive than treasuries. So in each example, you have more aggressive investments and less aggressive investments. So you're able to dial it in based on your risk tolerance, based on your time frame, based on how much you need. Okay, so I mean, I know this is a little, you know, a little subjective, but in this is how, without knowing your individual goals, without knowing each one of your, how much you're able to put in. This is why financial advisors have so much varying advice, right? Because the goals are all different. The amount you could put in is all different. Okay, you the kids' ages are all different. We need to when you sit down with an advisor or you sit down with your wife and you're trying to plan these out. It's very personalized to you. Not everybody is gonna have the same situation at all, and so that's why these are a little vague, just so I can kind of catch all of them. So let's take a look at some of these investments and how they return. Okay. So this is Bloomberg U.S. Aggregate Index. This is the bonds I was talking about. This is the bond index. Okay. PIMCO Income Fund, very famous fund. This is a dividend portfolio. Okay. Dividend portfolio. This would be probably on this side. Okay. You need $25,000 no matter what. Okay, this is over, I don't know how many years this is over. A little less than 20 years, and you need let's say you need $20,000. This is gonna get you there. Okay, this is growth of $10,000. All you did was put $10,000 in, let it grow, and you hit your goal. You outperform the market, or the index, not the market. Market is the S&P 500. You beat your index. Because again, you're not comparing this to the S&P 500. You're not comparing this to the stock market because that's not your goal. Your goal is to, on the left side, have a predictable return. The S&P 500 is not going to give you a predictable return. The bonds are, so that's why you're comparing it to the bond market. This is going to outperform the bonds. Okay? Now, people come to me all the time, and, well, when I was a financial advisor, they would come to me all the time, and they would say, market did 20%, how much did I do? Dude, you're not in the stock market. You're not even close to being in the stock market. Why are you comparing yourself to the stock market? Yes, we could get in the stock market, and I could give you, you could have got that 20%, but you opted for a much safer route based on your goals, based on your risk tolerance. So don't walk in here saying, where's my 20%? That wasn't the deal. Okay? You got to be realistic. Okay? You can't look at the market and say I would have had $35,000 in the market easily. Well, you can't predict the future. You were realistic. You made a consistent goal. You had longevity. You based it on your risk tolerance, and you met your goal. What more, do you need? Okay? Now, let's look at the Emerging Markets Fund versus the Emerging Markets Index. Okay? This PIMCO Emerging Markets is very aggressive, very unknown. See how it's fluctuating? Okay? Same outcome. But it got a little sketchy, right? You didn't at right here 2020, you barely had a little bit more than your initial investment. You didn't know whether you were going to reach your goal or not, right? This is the defined income. You kept putting in and putting in and putting in, and you're saying, "Oh, my vacation's not going to be very good," right? In 2024, my vacation's not going to be very good. I'm going to have to, eat hot dogs and live in a hostel. But then after 2020, boom, it went to 30,000 almost in 2 years, 3 years. It almost tripled, doubled at least. And now you just went from your hostel eating hot dogs to now you could go to have a nice vacation, nice hotel, because you properly aligned your goals with your investment. Okay? Both of these people reached their goals. Both of these people started with the same amount, ended with the same amount. Now, you may say, okay, you could have gone either path. You couldn't have gone either path because you couldn't have predicted the future. He may have had to go on vacation. Let's say let's say his wife got ill and she only had 6 months to live or something, and they had to go on the vacation in 2020. It wouldn't be a very good vacation. Here, they would have reached their goal. Okay, very different outcomes. Again, stress this enough. Your goal on the left versus your goal on the right. Okay, and the corresponding risk associated with it. Okay, now you may say, why? Let's talk about dollar cost averaging. Now you may say the top one. Why wouldn't everybody do the top one? Well, let's talk about it. Let's say you're putting in $100 every month. Okay, got $600 in there in 6 months. Share price kept going up and up. Your average share price is $7.50. Okay, this 100 was only $5 a share, so you got 20 shares. After 6 months, shares went all the way up to 10, consistently went up. This is a little, this is not going to happen. This is a little unrealistic. I'm just showing you the concept. You have $600, $7.50 a share. You got 85 shares. You got $845. This is basically like the PIMCO income fund. Just consistent. Very predictable returns. Okay? Your payment over here, same 600. This is the bottom one. Same 600. Variable sharing price. Very choppy share price. Up and down, up and down, up and down. But since you did the same amount here, same share price, 750, same average share price. Here you bought 20, but when it was at 9, you only bought 11. Hit 5 again, you dumped in, got another 20. Skyrocketed, went to 10. Okay? Now you have 10 shares. Okay? By the end, these were both at the same peak, right? We just talked about that. Same peak at the end. Same share price at the end. Same amount invested at the end. Everything's the same. The choppiness was what was different. This person got $845. She only needed 800. She got 845. Done, right? Good. Very predictable. Share price went up. Okay? This person has 88 shares in the same 6 months period. He was sweating it right here at $6 a share. He was sweating it, but it jumped. Now he's at 877. Outperformed. This is why you have the different types of structured goals. This is why it matters what you're saving for. This is why it matters that you have time frame, that you know how much you're investing, you know how much you're getting at the end, or maybe you don't. Like I said, your goal should fit into one of these buckets so you can know that you're going to get there the most efficient way possible. Okay? Now, the tools. How do you get the tools? Okay? Now, this is your homework. Okay? Now, in order to get the tools are at the brokerage firms. Okay? You need to have a brokerage account. It could be a brokerage account, could be an IRA, it could be a Roth IRA, but it has to be at a firm that has um, the research department, has all the graphs, has everything, and I'm going to show you how to use those next class. If you don't have those tools, you'll just be watching us, and you won't be able to participate or build your own portfolio based off your goals. Now, there's there's basically three types of brokerage firms out there. There's really not a lot of difference between them, um, especially in terms of fees. They're basically all free to invest, no account minimums. It's just how they market themselves. Okay, the full service, they're going to have a section for the ultra wealthy. We don't need that section. All we need is the research. Okay, Charles Schwab, E-Trade, Investment, Interactive Brokers all have amazing research departments. Zero account minimums. You don't even need to put $1 in there. Open account, you have access to all of their tools, all of their analysts. Don't have to pay any fees for it. Okay. Retail limited. These are going. These are for pros over here. They're full service. They're gonna have all the aggressive stuff. You'll day trade. They'll give you 7 times what your money is. You have $100,000. You could day trade with 600,000. This is going to be your full service over here. Your retail is going to be a little more scaled back. Okay, same fees. They have outstanding research. It's going to be a little. You won't be able to get yourself in trouble with these. Not a lot of. You can't trade a lot of options with them. They're going to limit how much leverage they give you. Still very, very strong companies. Okay, the discount ones are basically you see what you get. They have some research, I believe, but these are basically you can get crypto in these. They're marketed as a very low discount, but again, the fees are all the same. What else about the discount ones? Lost my train of thought. Anyways, in order to do the research tools, you either need to buy the individual tools, which is extremely hard. You need to get the subscription to the analyst that you like, or you get an account and they give it to you all for free. Okay, I don't. This is the biggest secret. I think nobody's telling anybody. Is if you have a brokerage account, you get access to all the tools, you get access to all the research for free. You, I, if you want, I could show you right now. We're ahead of schedule. Said, what do you think about Martin? How great people want to invest on their own? Or is it Edward Jones? Okay, so Edward Jones is what we call advisor based. That means 99 times out of 100, you're going to have an advisor that is given to you or assigned to you. And I don't know how much online access you have with Edward Jones. Anybody have an Edward Jones account? You could probably pull up your account and you could see if they have research or not. What you want is you want access to charts, you want access to analysts, you want access to portfolio makers, stuff like that. So let me get out of this. Oh, let me put this up for a second. This is how you book an appointment with me. This gets right on my calendar. If you guys have some other questions outside of this class. Again, this class was very aggressive. This is financial advisor level stuff. Trying to get you guys to a DIY type, do it yourself. Um, this is, if you have any additional questions, I'm on salary with the 88th. I work for the Army. Um, this is all my job. This is all I do. Meet with soldiers and teach classes. So let me show you what tools I'm talking about. Let me log in here for a second. I manage my family's money on E-Trade, and I invest with Charles Schwab. They both have nearly identical research. Alright, let me log in, and I'll show you here in a second. You're going to need access to these tools in order to do it yourself in our next class. Our next class is going to be going over these tools and showing you how to build your own portfolios, show you how to do research on the individual stocks, how to compare your investments to the benchmarks, how to put in trades, the different types of trades. So you're going to need access. Alright, so let me put this over here. Alright, so I recently bought Pfizer. It's near a 52-week low, very good dividend. But here's the research I'm talking about. Morning Brief, these are all general market research. You have Morningstar, you have Argus, Charles Schwab has their own. This is just on the individual markets, okay? But if you go to the stock, let's say Pfizer, it's going to take you to the stock. We're going to go over what all this means in the next class. It's going to show you all the charts. You'll be able to go to a chart analysis. You'll be able to do all the indicators. You'll be able to compare it with whatever you want. But let's go back. So again, this is what you want access to. Schwab rating. Here's all the reports. Why do they think it's a C investment? You could read about it. Why does Morningstar think it's a 5-star investment? You could read about it. Why does CFRA think it's a 4-star investment? You can read about it. Okay? All the news from this stock. Market edge, long. Okay? All the dividends, all the earnings, all the historical. This is all for free. This is all. You have an account, you have access to all this. This is no extra subscription. This is no extra fees at all. Okay?